maybe there's some advice that you can give to people where maybe if they are trying to sell their home and they're not getting the right price and they need to, they need to refi, what kind of products are available to them so they don't have to go into foreclosure.
Right. Well, here's what I'm going to say. Here's what I'm going to say. Right now, okay, as we explained in the first segment about the inverse yield curve in the bond market, I don't think if someone's buying a home, no matter how long they're going to be in it today, I don't necessarily see it as being advantageous to take out an adjustable rate mortgage. Only reason being is the biggest spread between maybe a 3-year ARM and a 30-year fixed mortgage is maybe 3/8 of a point. 2 years ago, it was a point to a point and a half. Let me explain. If I may, I'm going to write this down so people understand. Okay. Here we go. If somebody took out 3 years ago a 3-year adjustable rate mortgage and their rate was 5%, the day they closed that loan, their fully indexed rate was 7.5%, around that number.
Explain to everyone what that means.
I'm going to explain it. Okay. They got that mortgage, 5%, 3-year adjustable rate. Okay? The day they closed, they were assigned by the lender a margin of 3%. Okay? Typically, the adjustable rate mortgage loans follow either LIBOR index or Treasury index. Okay? At the time, the LIBOR index was 4.5%. Now, this is always going to be adjustable. If anything, today the LIBOR index has gone up to 4.8%. Okay? So the day they close their loan, this margin that they were assigned never changes. If you add the margin to what the LIBOR index was back then, their fully indexed rate was 7.5%. So what does that mean? If their loan comes due, their adjustable rate, in 2007, and interest rates did not go up at all during these last 3 years, their rate will likely go up by 2 points right off the bat, sometimes 2.5, depending on the cap of their loan.
So effectively, their payment is going to go up 50%.
Correct.
That's a big number.
A big number. Let me tell you how to get out of this.
Yeah, what does someone do?
You call someone like myself for a consultation, okay? And we game plan. All I could say is this. Right now, 30-year money is still a 0.5 point above 40-year lows, okay? You could get a jumbo mortgage, which is a mortgage over $417,000 today, at 6.125%, 6.125, and never worry it about adjusting ever again.
So effectively, someone who took out that 5% loan, it would go up, instead of going up 50%, it's only going to go up 20%.
Correct.
That's a huge difference.
Huge difference. And you know what? Who's to say if that person waits? Well, you know what? I'll let my loan adjust. I'll pay 50% more for a while. I can always refi into 30-year money. Is there any insurance that 30-year money is always going to be at 6.125? What if it goes up in a year to 7.125? They will have missed the boat.
Is this a unique scenario that the 30-year money is relatively close? Only, 20% is still a big increase. Is that a unique scenario that it's only 20% higher, whereas the fully indexed rate is 50% higher?
I think it is, Elliot, and the reason being is what we stated again in the first segment, the inverse yield curve in today's bond market. What's happening is you've seen short-term rates come up, and you've seen long-term rates not come up as much.
Why?
You know what? It's unexplainable. If you look at CNBC and you look at all these financial guys, I sure couldn't tell you, but I will say that no one could. It's definitely an odd condition in today's economy. That's what all the economists are saying.
Yeah, so does that say that that type of loan was a mistake, or just based on current, market conditions, this is a scenario we're presented with?
I don't know if it was a mistake, but here's what I do think. I think a lot of people got into these interest-only and adjustable rate mortgage loans just because they could. Just because they could take the lower rate. Some people might have thought, well, I'm only going to be in the property for 3, 4, 5, 6, 7 years. Now they've had 2 kids and put on an addition, and they plan to be there till the kids get out of college.
Okay, let me ask the question a little differently.
Sure.
Let's say we're talking primary residence,
right.
Vacation home.
Right.
Talk to me about the people who have speculated
okay.
on all of these condominiums, single-family homes, they're in a situation where there's potentially a glut in the market, depends where we are in the country. What do those people do? Are these kind of loans available to them as well?
They are, or if they really want to save a quarter to 3/8 of a point, they could take out another 3, 5, or 7 year ARM, maybe at 6% or in the high fives. If you're asking me, I'd rather be safe and conservative if it was me, and just go with the 30-year money at 6 1/8. You can also buy 30-year money today and buy it with an interest-only option, meaning your rate will never change. However, you have the ability to pay just the interest.
Explain to everyone, every time you get your payment stub, a lot of these loans, they have like 3 or 4 different options as to what you can pay. Explain to everyone, because, it's interesting. I'm in the business, and, there's a property that we own, and my wife was paying the minimum payment.
Right.
And they put it in big, bold print. So you have the minimum payment, which is probably twice the size of the interest-only payment, the principal and interest payment.
Half the size.
Why did they do that?
Well, that's what they call the good old negative amortization loan. What you're doing is they're selling you, the lenders, on this attractive payment that's actually less than interest only. You're not even paying all of the interest, and you've seen it advertised all over the place, 1%, 2%. I like to compare that in the days in 99 and 2000 where people were speculating with these NASDAQ stocks, in the penny stock market, and they were making 50% on their money in a day. Sure, you could take that kind of loan. You know what? If you're a very wealthy individual, maybe if you're speculating with real estate, it's not so bad to take that loan. Why? Because you're taking other monies that they're not going to paying off that loan, and you're taking them and you're investing them in stocks, bonds, art, what have you. Okay? However, a lot of people got tricked into those loans. They just saw that lower payment. What they don't understand is every time they pay that minimum monthly payment, their principal on their mortgage is increasing.
Well, I thought was very interesting was you could have had a regular type loan, not even the 1% and 2% loans, but just a regular loan.
Yes.
But they include that option on the payment stub.
Really?
We had, I forget what type of loan it was, but it was a normal.
You don't think it was a negative amortization loan?
No, it was just on there. My wife is paying it, and I looked when we sold the property, and I'm like, wait a second, we've had this thing for 4 years. It's principal and interest. How come the loan is up a little? And then we realized what she was doing, and it's interesting, if we make those kind of mistakes, anybody could be making those mistakes.
All the more important to not only consult a loan officer, loan consultant that you trust, but it's good maybe to chat with your financial advisor, your CPA, and really investigate. It's funny. Don't always go and try to save that 1/8 of a point and go with the person that's an 1/8 of a point lower necessarily, because they could be the person that's selling you down the river.
Well, that's it's a great segue, and this is what I want to really ask you about. You mentioned about your alliances with Costco and also with LendingTree. The business has changed from a very localized business to really a global, or in this case, let's say a national type business, where you and companies like WCS Lending can do loans all over the country. What happens is it just about the rate? Because it seems like people shop it all the time, and that's the only thing they're thinking about. So what is your comment about that?
I got so many different things I could say about that, but to keep it short and quick, what people don't understand is they're going to 10 different banks and shopping their rate when they could be going to one mortgage broker who will take care of all that for them. And by the way, that mortgage broker many times won't even be as cheaper or expensive. Then it'll be the same cost to them.
I guess it's, you get what you pay for.
You get what you pay for. But more importantly is what you brought up before. Don't necessarily, in my opinion, go with somebody because they're an 1/8 lower. Go with the person that has educated you about all the products available to you and the upsides and the downsides of all of them. Go with the loan officer that's going to make you feel the most comfortable.
Well, that's an extremely great point. I think it's a great segue to the next segment. I really want to talk about some of the common questions most people come to you that you're able to solve. Sure. So we'll talk about that in the next segment.
Terrific.
So we'll be right back with Real Estate Today.